Welcome to Goldnest Investments. Today we're exploring the top 5 mistakes that new investors often make. Whether you're just starting your investment journey or looking to refine your strategy, understanding these common pitfalls can help you build a more secure and profitable portfolio. Mistake number 1. Investing without a clear plan. Embarking on investing without a well-defined plan is like setting out on a journey without a map. Many beginners dive into the market without establishing their financial goals, risk tolerance, or investment timeline. This lack of direction can lead to impulsive decisions and inconsistent results. Before investing, it's crucial to determine your objectives. Are you saving for retirement, a home, or your child's education? Understanding your goals helps in selecting appropriate investment vehicles and strategies. For instance, if you're investing for a short-term goal like buying a car in 2 years, you might opt for less volatile investments compared to someone investing for retirement 30 years down the line. Additionally, consider your risk tolerance. Are you comfortable with the ups and downs of the stock market, or do you prefer more stable investments? Assessing your comfort level with risk will guide you in building a portfolio that aligns with your financial and emotional capacity. Mistake number 2, trying to time the market. Attempting to predict market highs and lows is a common trap for new investors. The idea of buying low and selling high is appealing, but consistently timing the market is nearly impossible, even for seasoned professionals. Instead of trying to time the market, focus on time in the market. Regular, consistent investments, known as dollar-cost averaging, can mitigate the impact of volatility and lead to more stable returns over time. This strategy involves investing a fixed amount at regular intervals, regardless of market conditions, which can reduce the risk of making poor investment decisions based on short-term market fluctuations. Remember, the stock market has historically trended upward over the long term. By staying invested and not reacting impulsively to market dips, you increase your chances of achieving your financial goals. Mistake number 3, lack of diversification. Putting all your eggs in one basket increases risk. New investors often concentrate their investments in a single stock or sector, making their portfolio vulnerable to specific market downturns. Diversification, spreading investments across different asset classes, industries, and geographies, helps reduce risk and can lead to more consistent performance. For example, if you invest solely in technology stocks and the tech sector experiences a downturn, your entire portfolio could suffer. However, if your investments are spread across various sectors like healthcare, energy, and consumer goods, a decline in one area may be offset by gains in another. Consider incorporating a mix of stocks, bonds, mutual funds, and exchange-traded funds into your portfolio. This approach can help balance risk and reward, providing a more stable investment experience. Mistake number 4, letting emotions drive decisions. Emotional investing, reacting to fear or greed, can lead to poor decisions like panic selling during market dips or chasing hot stocks during rallies. These reactions often result in buying high and selling low, which is the opposite of a successful investment strategy. To avoid emotional investing, establish a clear investment plan and stick to it. Set specific goals, determine your risk tolerance, and create a diversified portfolio. Regularly review your investments, but avoid making changes based on short-term market movements or sensational news headlines. It's also helpful to automate your investments through regular contributions to retirement accounts or investment plans. Automation can remove the emotional component from investing, helping you stay disciplined and focused on your long-term objectives. Mistake number 5, neglecting to rebalance the portfolio. Over time, your portfolio's asset allocation can shift due to market performance, potentially increasing risk beyond your comfort level. For instance, if stocks perform exceptionally well, they may comprise a larger portion of your portfolio than intended, exposing you to more volatility. Regularly reviewing and rebalancing your portfolio ensures it aligns with your risk tolerance and investment goals, maintaining the intended level of diversification. Rebalancing involves adjusting your investments to return to your target allocation, such as selling some assets that have increased in value and buying others that have decreased. It's advisable to review your portfolio at least annually, or when significant life events occur, such as a job change, marriage, or the birth of a child. This practice helps keep your investment strategy on track and aligned with your evolving financial situation. Investing is a journey, And avoiding these common mistakes can set you on the path to financial growth and stability. Remember, plan wisely, stay diversified, keep emotions in check, and review your portfolio regularly. If you found this video helpful, give it a thumbs up, subscribe for more investing tips, and share your thoughts or questions in the comments below. Thanks for watching, and happy investing.